Is it possibly something called silver coin? You know, you take something out of the ground, put it into a metal. Okay, I'm being a little sarcastic. I actually mean silver, the actual physical metal. It's been hot. You've been a long time bull of silver and a lesser extent gold. Do you remain bullish on the metals?
I am, Brian. I think, look, gold, as money leaves crypto and people are still looking for inflation hedges, gold and silver are going to be much better places to go. It's going to take a while to build a momentum in gold because the size of the market is so much bigger and there's so much gold in the world. But ultimately, I think gold will move into an exponential phase. I think $5,000 to $10,000 an ounce for gold ultimately is in the cards. And after gold starts to make a move, silver traditionally lags, and silver is the poor man's gold, and it's the one that will have the largest move on a percentage basis ultimately. So it's the high beta version of gold, and I think having a fairly significant allocation to that and the gold miners, GDX, would make a lot of sense right now.
That was bond trading billionaire Scott Menard only a few days ago. Mr. Menard is both a managing partner and global chief investment officer at Guggenheim Partners, a global investment and advisory firm with more than $315 billion in assets under management. He also currently serves on the Investment Advisor Committee on Financial Markets for the New York Federal Reserve Bank of New York. It will take some time due to the sheer size of the gold market, but the precious metals will enter an exponential phase, he states. The ultimate price target for gold is between $5,000 and $10,000 an ounce. This is ultimately in the cards. Silver traditionally lags. It is the poor man's gold, and it's the one that will have the largest move on a percentage basis. It is the high beta version of gold. This is but a quick look back to the last major secular bullion bull market of the 1970s into early 1980, where we can see that silver lagged and then briefly outperformed gold before the COMEX and CFTC changed COMEX silver futures trading rules to liquidation orders only, effectively cutting the legs out from the over-leveraged Hunt Brothers and other silver betting bulls at the time. Stay tuned to the end of this week's SD Bullion Market Update for a click-through link of a video detailing facts from the often fabled Hunt Brothers silver saga of the 1970s and early 1980 run to silver's still all-time high price of 50 fiat Fed notes per troy ounce. Here's where we stand in this 21st century secular bullion bull. And unlike the last version 4 decades ago, this time, it's hard to paint a scenario where both silver and gold could crash, as hard as last time, when the then United States of America had less debt to GDP, and thus way more of an ability to increase interest rates upward to nearly 20% per year. If you recall the summer of 2019, when the federal funds interest rate only reached 2.4%, the financial markets began self-imploding under our collective, still expanding record debt piles accruing. In short, this ongoing secular bullion bull is a lot different and larger than the last. This week, we'll examine but a few of those differences at play currently. Hello there, on behalf of SDBullion.com, this is James Anderson bringing you this week's SD Bullion Market Update. Before we continue, smash the like button so others can get this important bullion-related information served to them as well. Silver and gold spot prices finished the week slightly lower in fiat Federal Reserve note values. Let's see if by this time next week both precious monetary metals can close above 28 and 1900 respectively. The gold-silver ratio finished the week unchanged at 68. In terms of their respective 200-day moving averages, both gold and silver appear poised to have strong showings this summer 2021. On a fundamental basis for silver investors, we should take note of the following 2 excellent SRS Rocco report charts. The first illustrates that annual global silver supply has been shrinking since its peak in 2016, while simultaneously in the last year and a half, net silver investment demand for ETFs and silver bullion buying has been record-setting, at a pace where over 70% of net silver supplies coming to market are being offset by massive silver investment demand ongoing. Shortly, we'll look at a few anecdotal pieces of evidence backing up this data. But following up on their global silver shortage comments from last week, the U.S. Mint sent another email to their customer list, hoping to clear up remarks they made just last week, stating that their reference to the global shortage of silver was directed at their ongoing lacking supplies of silver blanks, currently being underprovided by their silver suppliers. The U.S. Mint continues to try and provide what has historically been the world's most often purchased retail silver bullion investment vehicle, the 1-ounce American Silver Eagle coin, and for the month of May 2021, the U.S. Mint sold not 1 ounce of them, backing up their claims that they are currently indeed suffering under a global silver bullion bank supply crunch, while they are also transitioning new dyes and machinery for the format change to their most popular silver and gold bullion coins. Interestingly, the Perth Mint silver bullion coin sales continue to hum along at high historic rates, while the Royal Canadian Mint just reported this week record high volumes of sales for their popular 1-ounce silver bullion coin program, having sold nearly 10 million ounces of them in the first quarter of 2021 alone. In troy ounce terms, the Royal Canadian Mint is reported having sold over 52% more silver maple leaf bullion coins than Q1 2020. And judging by these anecdotes, it doesn't seem that the silver bullion investment demand is waning from its record levels in 2020, rather that they may be increasing overall this far in 2021 compared to last year's record pace. One look at some of the price jumps in commodity prices over the last few years in Fiat Federal Reserve note terms, and it's not surprising that internet search volumes for the term inflation are setting records in the United States and Canada respectively. Also not surprising is that demand for historically sounder stores of value like gold and silver are at record paces as well. Turning to the stock market bubble ongoing, chalk up another short-term win for the Wall Street bets crowd and the respective hedge funds using them as cover, while short-squeezing stocks like AMC to all-time record price highs and ridiculous valuation levels. In just over 4 months of time, the unassociated subreddit offshoot called Wall Street Silver has now grown its legion to nearly 100,000 members. It's going to be interesting to see how long it takes for this number to double. Here is a quickly building reminder of what's at stake. The world's largest 7 economies are rapidly and actively working on central bank digital fiat currencies to act as the next supposedly safe payment settlement system for the world, one which could further limit our already dissolving privacy and self-sovereignties collectively. The Asian Nikkei newspaper writes, alarmed by China's push, G7 rushes to set digital currency rules. Financial chiefs to discuss state monitoring of financial transactions. G7 nations are worried that China's digital yuan could be used to track people and suppress political opposition. Financial chiefs from the group of 7 major economies will discuss rules for digital currencies issued by central banks, hoping to bring China's digital yuan into an international regulatory framework. The G7 finance ministers, who kicked off a 2-day meeting in London on Friday, will sort out potential issues arising from state-issued digital currencies with the aim of announcing new rules as soon as this fall. China's aggressive push to issue a digital yuan has raised concerns that it could give rise to a new economic zone centering around nations taking part in its Belt and Road Infrastructure Initiative. Such a framework could undermine the current currency system based on the US dollar. China has issued the digital version of its national currency last October. As part of a large-scale pilot program, the government plans to officially bring the currency into circulation by the end of next year. If such a digital yuan economic zone becomes a formidable presence, Western sanctions, such as blocking transactions in dollars or other key currencies, a typical tool of punishment for countries that violate international rules, would become toothless. Furthermore, the Chinese government will have access to the digital yuan transaction data. Not only would that infringe on data privacy, but it could be used as a tool to suppress speech and push out political opponents. In their previous meeting last October, G7 finance ministers and central bank governors released a joint statement calling for transparency and the rule of law for such currencies. 7 central banks in Western nations and Japan have formed a joint research group with the Bank for International Settlements that have outlined foundational principles for central bank digital currencies. For one, a central bank should not compromise monetary or financial stability by issuing digital money. G7 countries will further elaborate on those principles during the London meeting. Central banks in advanced nations are also formulating specific plans for their own digital currencies. The Bank of Japan launched a pilot program in April to test transactions using a digital currency. The European Central Bank will likely make a decision in the coming months on whether to launch its own test program. Last month, the U.S. Federal Reserve said it would issue a research paper this summer on issuing a digital currency. This G7 meeting is the first face-to-face gathering of financial leaders since the Group of 20 met in Saudi Arabia in February 2020. And to date, this is likely underreporting the ongoing development of CBDCs, but this is a map of what's been reported as to date as to which countries are actively doing so and are on the cusp of implementing new fiat central bank digital currencies. Ultimately, these will be tools to help melt away the massive record global debt levels that we've accrued and continue to keep accruing. Obviously, the fiat CBDC systems will be used to nominally default on promises we never intended on keeping. And here to close this week's SD Bullion Market Update is Scott Menard again to essentially echo what I just stated.
I think the central bank will step in to contain the rise in rates. And that's what we did in the 1950s, or the 1940s and the early 50s. And what we saw was that, asset prices continued to percolate along, and eventually inflation became dominant. And by the time we got into the late 60s, inflation was a problem. And there are only three ways out of the debt we're in. One is to default, which I don't think is likely. One is to restructure, which candidly is just another form of default, or the other way is to inflate it away. And Carmen Reinhardt and Ken Rogoff's book, This Time It's Different, basically point out that at the end of this all, that will be the path of least resistance for policymakers.
And as always, thank you for coming by, and take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.